Hey, welcome to our explainer on a book that absolutely shook up the world of economics, Thomas Piketty's Capital in the 21st Century. It's a massive work, but it completely changed how we talk about wealth and inequality. So let's get into it.
Everything in this book really starts with one big nagging question. What if capitalism has a kind of hidden code, a fundamental force baked right into the system that automatically pushes us towards more and more inequality? That's the mystery Piketty wanted to solve.
All right, so let's dive right in. The amazing thing about Piketty's work is that he didn't just come up with a theory. No, he and his team rolled up their sleeves and dug through 300 years of data from over 20 different countries. They were looking for a pattern, and they found one. And it all boils down to this tiny, almost laughably simple formula. R is greater than G. This little inequality right here, this is the engine that drives the entire book. It looks harmless, right? But its consequences are absolutely massive.
So to really get why this little formula is such a bombshell, we've got to decode it. We need to break down what R and G actually mean.
Okay, first up is capital. Now, when Piketty says capital, he doesn't just mean cash sitting in a bank account. He's talking about the whole shebang: real estate, stocks, bonds, business assets. Basically, anything you own that can make you more money. It's not just wealth, it's wealth that's actively working for you.
And that brings us to R. R is the rate of return on that capital. You can think of it as the speed at which your wealth grows all by itself. So if you've got $1 million in assets and they spit out 50 grand a year in profits, dividends, and rent, well, your R is 5%. And then finally, we have G. G stands for economic growth. This is the one you hear about all the time on the news. It's the rate at which the entire economy gets bigger each year. And crucially, it's tied to things like job creation and how much our wages go up from the work we do.
Okay, so here's where it all clicks. When R is greater than G, it means that the money made from owning stuff is growing faster than the economy itself. In other words, wealth that already exists, often from the past, is accumulating faster than people can earn new wealth from their labor today. It's a dynamic that mechanically, automatically widens the gap. Now, when G is greater than R, you get the opposite effect. A rising tide tends to lift more boats, and inequality can actually shrink. Now, here's Piketty's big aha moment. It wasn't just coming up with the formula. It was showing that this pattern, this R greater than G, has been the historical norm for centuries, with one huge, dramatic exception. And looking at this history is what makes his argument so compelling.
This timeline tells such a wild story. You see, back in the 19th century, R was way bigger than G. This was the golden age of inherited wealth. But then, from about 1914 to the 1970s, something incredible happened. 2 world wars and the Great Depression literally destroyed vast fortunes of capital. At the same time, post-war growth was unusually high. For a few decades, G was actually bigger than R, and inequality fell. It made us think we solved the problem. But Piketty's data suggests that period was the exception, not the rule. Now, with slower growth, R greater than G is back with a vengeance.
And nothing captures the reality of that 19th century world better than this quote from Balzac's famous novel. A character is basically telling this ambitious young man, forget your career, forget working hard. The math was just brutal. No salary you could earn, no matter how prestigious your job, could ever hope to compete with the income from a massive inheritance. So marrying into wealth wasn't just a romantic plot point, it was the most logical economic move you could make.
So if we really are heading back to a world where R is bigger than G, what does that actually look like? Is it just the 19th century all over again? Well, not exactly. Piketty points out that high inequality can actually have 2 very different faces. On the one hand, you've got what he calls the hyper-patrimonial society. That's 19th century Europe. It's a world run by rentiers, people who just live off the income from their inherited wealth. They don't really work. Their money works for them. On the other hand, you have something like the modern United States, which he calls a hyper-meritocratic society. This world is dominated by supermanagers, top executives earning absolutely astronomical salaries from their jobs. And you can see this shift plain as day in the data. Back in the Roaring '20s, the richest 1% in the US got most of their income from capital, from their investments. But fast forward to today, and it's completely flipped. Now the huge majority of their income comes from labor, mostly in the form of those massive executive paychecks. So you might be thinking, okay, hold on. If today's super rich are actually working for their money, does that R to G thing even matter anymore? Hasn't the game changed? It's a really good question.
Piketty's answer is a resounding yes. It still matters. For one, today's huge salaries very quickly become tomorrow's huge piles of capital. But there's another, more subtle reason. R isn't the same for everyone. This table on university endowments is the perfect example. Just look at the difference. The biggest endowments, like Harvard's and Yale's, consistently get way higher returns than the smaller ones.
And why is that? It's because having a massive pile of capital gives you access to the best financial advisors, and access to sophisticated, high-return investments that are completely off-limits to smaller players. Wealth itself becomes a tool for generating even more wealth, which just pours fuel on that R greater than G fire. It's a powerful feedback loop.
So, if this inequality spiral is a fundamental feature of capitalism, Piketty asks a tough question. What can we do about it? He argues that if we just let things run their course, we're heading for levels of inequality that could really challenge the democratic, merit-based ideals we say we believe in. And this brings us to his most debated proposal, a progressive global tax on capital. Now, the key thing to understand here is that its main purpose isn't even to raise money. The primary goal is to create financial transparency. It would force us to track huge fortunes as they move around the globe, preventing them from hiding in tax havens. And with that information, we could finally have a real democratic conversation about how to manage and regulate capital in the 21st century. It's about letting citizens make choices instead of being run over by blind economic forces.
And that really leaves us with the core question of the entire book, and maybe the core question of our time. Is this powerful tendency towards ever greater inequality a glitch in the system that we can fix? Or is it a fundamental, inescapable feature of capitalism's code? Piketty's data has laid out the diagnosis. The debate over the cure, well, that's just getting started.